Meta stock is up more than 500% since early 2023. But is there any upside left for investors? In today's webinar replay, you're going to see us break down Meta stock from scratch, including research the company's business model, moat, valuation, risks, and so much more. All in an effort to see if this company's stock deserves a spot in our portfolios. Enjoy. All right, so how are we going to research this stock from scratch? We are going to use our custom stock simplifier tool and protocol. So there are 7 sections to researching a stock from scratch. That's exactly what we're going to be doing throughout this webinar. If you're unfamiliar with stock simplifier, it is a full course that takes you through each of these frameworks in more detail. There is a tool that we can use, a Google Sheets tool that we have, and we'll also have some AI prompts you're going to see us use throughout here. But question number 1 that we ask for researching any stock from scratch is, which phase of the business growth cycle do we think Facebook, aka Meta Platforms, is currently in? So let's run a poll. I like to do the poll kind of beforehand. Which of the 6 stages using this visual chart do you guys think Meta is in right now?
Brian, I'm curious what people say, because I think that there is a wrinkle to this question
There's
for
always a
Meta.
wrinkle. There's
There's
always a
always a
wrinkle.
wrinkle, but
The
that
framework is the important part, right? The
hmm
exact detail you land on isn't nearly as important as the mental model of doing the analysis.
Yep, I agree. So we give people about 30 seconds, because this one is just kind of like, what's your opinion?
Yeah. So
And
while that's running, let me
mhm.
open up some tools here. So here's Stock Simplifier. If I go to the Alt Course Tools section, we're of course going to want to open up a fresh copy of Stock Simplifier. I'm also going to open up fiscal.ai so that we can do the research. I'm also going to open up a copy of our AI prompt database, and for this one, we're going to be using ChatGPT to do the analysis. So okay, so what do people say? What's the consensus right now?
So 61% said stage 4, operating leverage.
Okay.
34% said stage 5, capital return. And the one wrinkle that I wanted to throw in there is, this Meta is so big and so tied to the advertising industry, and advertising budgets are the first thing to be cut in a downturn,
Yep.
that this has become, and I think will continue to be, more importantly, more cyclical than anything. So I think it will bounce between stages 4 and 5 depending on where we are in the cycle.
Yeah, I think that is. I think that's fairly accurate. But since people are saying the operating leverage phase, let's go ahead and see if ChatGPT agrees with that analysis. So first, I'll just oops, wrong target. Meta is the ticker is a ticker symbol we put in here. I will zoom in a little bit. So we're looking at revenue growth, we're looking at operating profit growth, and we're looking to see, is the company returning capital to shareholders. So first thing we're going to do is we're going to copy over the prompt to do the business growth phase analysis. Then I'm going to go to ChatGPT. I'm going to paste that in. If ChatGPT is working nicely, it should ask us, what company do you want me to analyze? So Meta, which is Meta. And let's see what ChatGPT says. Okay.
There you go.
ChatGPT says the current stage is phase 5, capital return, and it has high confidence in this guess. Why? Well, it says evidence. Operating income was $17.6 billion, a positive figure. Revenue grew 16% year over year, 42 billion versus 36 billion, and it got that from Meta's first quarter earnings report. Capital returns, yes. The company repurchased 13 billion worth of stock and paid dividends of 1 billion just in Q1 of 2025. So it is saying phase 5 because the company is actively returning capital to shareholders. Now, why is that important? Well, the most useful valuation methods for a phase 5 company are the trailing price to earnings ratio and the trailing price to free cash flow ratio. The company is mature with stable operations and is returning capital to shareholders. Current earnings and cash drive valuation, drive business and valuation. Do you agree with that?
I think what you said before is the most important thing, which is, this is a mental model. And I think this is both phase 4 and phase 5.
Yeah.
I
So
I, I think you could do either one.
I'm definitely going to agree with this and say phase 5 because the company is buying back stock and the company is paying a dividend. So to me, that is a delineating line between phase 4 and phase 5. So I'm going to say it is a phase 5 company. Now, why is that important? Because the metrics that we use to analyze the business and the valuation that we use to analyze the business change depending on which stage of the business growth cycle the company is currently in. So we're going to say phase 5 here. Now, if you're unfamiliar again with how to figure this out, we do have all the details in this in the Stock Simplifier course that we have. But for right now, we're going to go with phase 5.
And of course, I just throw out there, if you've got the tool and you don't agree, like Tom's saying, look, it's growing faster than like 16%. That's what, if you've got the tool, do it with phase 4, because
Yep.
we're not saying you can't do that.
Yep. It's the mental model. That's the important
Yep.
part. All right. Question 1 is done. Question 2. It's time to figure out, what does this company do? And broadly speaking, we want to know, after we answer these questions, are we confused? Which means stop. Do we understand the business, but we're not that excited? Or are we excited about the company? So there are 7 key questions that we want to ask about the company. 4 are just quantitative. What does it do? 3 are qualitative. Can the company raise prices? How often do the customers buy? Etc. So we have a prompt that is built just for this. It's the business analysis prompt. We're going to go over to ChatGPT. We're going to paste that prompt in there. And it should, again, say what company. And we're going to say Meta. And let's see what ChatGPT
I'm
comes
curious
up
what
with.
kind of breakdowns ChatGPT can give us, because it's been a while since I've dove into Meta's filings.
Yep. And we can, of course, back up some of this analysis with fiscal.ai to make sure. Okay, using Meta Platforms 10K from 2024 and 10Q for the quarter ending March 31st. And there is the filing right there that it did pull up. So you can click that to just double check. Okay, what does Meta do? Meta operates a family of apps and technologies, Facebook, Instagram, WhatsApp, and others, and invests in augmented/virtual reality and artificial intelligence. Sounds accurate to me.
Yep.
How does it make money?
There you go.
Advertising, 159 billion, 97
97%.
from ads across its apps and app platform. Reality Labs and others were 4 billion, or 3% of revenue, from hardware and other Meta type glasses. So this is a ad company.
Yep.
No matter what they call themselves, it's an ad company right now. Who are the customers? Individual users of its app and advertisers, businesses of all sizes that buy ad space across Meta's platform. So let's dig into that a little more. It says individuals are the customers, and I would say nope.
Yeah.
Advertisers are the customers.
Yeah.
If you have not given Meta money, you're not the customer. So
Yeah. Truth be told, the individuals are the product.
yes, the attention is what they're selling. Advertisers are the customers here. Although I guess I should say individuals that have bought the Reality Labs products, the glasses, they are customers, but they're a minority of customers. Okay, where does it operate? U.S. and Canada is 47% of revenue. Europe is 19% of revenue. Asia Pacific and rest of the world is 34% of revenue. Wow, that's higher than I would think outside the U.S. The U.S. is only half of revenue.
Yep.
Okay, so we know what the company does. It's a fairly straightforward business to understand. How often do customers buy? Advertisers commit regularly, monthly or quarterly, to ad spending, and users continuously engage with the apps. The model is largely recurring for advertiser revenue instead of one-time purchases. Makes sense to me.
Yep.
Can the company raise prices? Yes. Evidence shows that ad prices, average price per ad, increased 10 to 14% year over year in 2024. And the company highlights monetization of new formats like Reels and expanded global footprint, indicating pricing and volume leverage. Would you agree with that?
So there's actually a really, if you want to dive into fiscal AI and just go to segments and KPIs, we can double check that, because I think what's most helpful is to get like a look at how they can raise prices over time.
What segment would you like me to look at in
So
particular?
if you go down,
Yep.
and you go to, there should be one, keep going down, keep going down, keep going down, keep going down. There's one in there. There should be one in there that's like price
Revenue per
per
user?
ad. Yeah, revenue per user.
Okay. Revenue per user.
I mean,
That's pretty definitive.
yeah, I think it's pretty definitive. You know what? I might be wrong. Maybe it's Google/Alphabet that tells price per ad that they report.
Well,
So
this is just revenue per user. It used to be $12, now it's $45, and
yeah,
this is
that's pretty good.
worldwide.
That's pretty good.
That's worldwide. And look, it has daily average users, it
Yeah,
has monthly active users, and then family average revenue per
but
person. So
they stopped reporting that one.
that's actually the newer metric. I think the worldwide one they stopped reporting. Um, this is the
Oh
one
yeah,
that they
yeah, yeah. You're
started
right. You're
referring.
right.
So
Mm-hmm.
basically, $50 per family,
Mm-hmm.
$50 per family. So I would say that is a sense of pricing power. I know that Google, for example, has been trading off lower prices per ads with higher volume of
Right.
ads for quite some time. So can it raise prices? I'm gonna go with
I'd
yes.
say maybe.
There you go. Fair. Interpret that as you will. All right, next. What happens in a recession? Meta is somewhat cyclical because advertisers' budgets shrink in a downturn. 100% true.
Yeah, I would even. It's a little bit more than somewhat, I would
The
say.
company's risk factors mention macroeconomic weakness is a headwind. However, its large user base and diversified geography impart some resilience. So let's actually test that. So if we go to the financials, and we go to the income statement, we should be able to see that.
And you can.
Um,
I mean, look at what happened in 20. Everybody pulled back on their ad budget in 2022,
yep,
and because they were like, the thing is a recession can be bad for Facebook, but fear of a recession is just as bad
yep,
because that's what happened.
yep. So revenue did decline only by $1 billion though between 2021 and 2022, and that's when a whole bunch of VC-backed companies lost their funding. Right.
Mm-hmm.
So you would maybe the company was over earning here and more normalized here. So it did decline. It declined by about 1% though. So
Mm-hmm.
not that scary. We don't have data from 2008 going back here, but I will say that the company's revenue is sensitive to the economy. Not crazy sensitive, but it is sensitive to the economy.
Yeah.
Yep. Okay. So what do you guys think? Now that we have analyzed this business, is Meta an attractive business? Yes, kind of, or no? How would you guys rate the quality of this company's business?
Yep. And we'll leave that up for about 30 seconds. I'll just say, you know, with the kind of network that Meta has and their ability to launch a new product, like Brian, Reels is pretty popular, isn't it?
Very popular. Yeah, they've done a great job of mimicking things they see out there in the market and basically launching them. I mean, Threads has become a very serious competitor to Twitter. A lot of people when it launched thought it was a joke, but now it is the activity of Threads is catching up to Twitter.
So,
X.
Brian, 70% of folks say yes, it's attractive, and the other 30% say kind of. So I'd say we're pretty solidly green. Just one quick question for you, Brian. Madhu's asking, how do you figure out if the business has reached saturation?
Growth slows dramatically.
Growth of what? Revenue,
Revenue.
users.
Yeah, all of the above.
Okay.
From a user perspective, growth has slowed pretty dramatically, but they are still growing, which is incredible,
Yep.
right? So the growth rate of users is in the low single digit percentage basis, which is still extremely impressive.
Yeah.
Revenue is the thing to watch, though, for me. Revenue growth year over year in particular. So I think that we can qualify this as an attractive business. Fresh reminder for people that are watching, when we do these webinars, a stock simplifier is normally $199. If you do want to access everything that we are using to research this stock from scratch, it is $99. Stoffel, if you could put a link on YouTube and in the chat, that would
Yep.
be fantastic. Okay, question number 3. Moat. Does Meta have a moat? And specifically, is that moat narrow? Does it not have a moat, or is the moat weakening? Is it narrow and is it stable, or is it wide and or expanding? So there are 5 sources of a moat. We want to know what is the current moat size, and as importantly, maybe even more importantly, what is the direction of the moat? Is it shrinking? Is it stable? Or is it widening? So let's poll the audience before we start here. What do you think is Meta's primary source of the moat? Is it network effect, switching costs, low cost production, intangibles, or is it counter positioning?
I know with this one, there's one force at play, and I think it can be called two different things.
Okay, maybe we can dive into the nuance of that in a little bit. Perhaps not surprising at all. We have a runaway winner.
Yep, network effect is 80%.
Yeah.
And my only thing that I was going to say is I think it is network effect, but I also think it's low cost production because Meta doesn't have to pay very much to just maintain their properties related to their business size, and they collect the thing that they produce at low cost as data.
There you
Like
go.
you just can't get it at such a low cost anywhere else.
Anyway, I'm copying over the AI prompt. I'm going to go to ChatGPT, and we're just going to see what ChatGPT says if it agrees with our analysis. Okay, it should say what company we're talking about, or unless it's just going to go right to Meta. But no surprise that was the most popular option, right? We've seen,
No.
In fact, when people are talking about an example of a company with a network effect, they often point to Meta.
Yeah.
Ooh, this is new. Thanks. Before I run the analysis, I want to double check one thing. I need to buck resources. Strict SEC only. Just reply A or B. I want to go with B. I want SEC and Morningstar ratings. That was new for it to ask that.
We haven't seen that before. We're learning something new here.
Yeah. All right, here we go. So the moat analysis for Meta. The current moat is wide. The current direction is stable. Primary moat sources are network effect and intangible assets. Meta Platforms enjoys wide economic moat driven by its massive user base and enriched social network effects, 3.35 billion daily active people in 2024, and a 14% increase in average price per ad. Okay, switching costs. It says, yes, it does have switching costs. They're narrow, but they're stable. Users could theoretically switch to another platform, Meta's family of apps, create multi-app stickiness that raises friction. And then there are supporting data with that. Many people in our community have user accounts on more than one of our products. I mean, I have a user account on every single one of their products personally. Intangibles. Yes, they are wide and they're stable. Meta has strong brand recognition and a suite of proprietary products and trademarks, and has accumulated goodwill and intangible assets. No argument there. Network effects, wide and widening. The more users and advertisers use Meta's platforms, the amount of value they generate. For both sides, higher budgets attract more content and strengthening the network effect. It says no assessment for low-cost production.
Again, I think it's semantics, but I understand.
Its cost structure is not explicitly claimed to be substantially lower than all competitors that give it a durable, low-cost moat. So you would disagree with that?
I mean, here's the thing. I call it low-cost production, but it's also the network effect. So
Sure.
I wouldn't have a problem with that.
And then no counter positioning. Its business model is not novel. Risks and final consideration, slowing user growth and rising regulatory competitive threats are something to keep an eye on. Competitive landscape like TikTok and regional limits. And valuation is a risk, but we're going to get into that. But overall, wide moat with a high uncertainty rating. So personally, I would say that this moat is very wide, and at the worst, I would say it's stable. I personally don't think it's under attack there. So I think we can say yes, this company does have a moat. Next, great, it's a good business with a wide moat. Why should we believe that this company can continue to grow? And is the growth prospects here low? Are they good or are they great? Now, how do companies grow? 2 choices. Choice number 1, get new customers. Choice number 2, get your existing customers to spend more. So there's investing in sales and marketing, there's opening up new distribution, entering new markets, improving products and services, raising prices, and all of the above. Now, a shorthand we teach you in Stock Simplifier is to simply go to the overview page, scroll down till we see right here, earnings per share long-term growth. So analysts believe that Meta's earnings per share should grow about 16% over the quote unquote long term, which I take that to mean as 5 years or so. So that's what analysts are projecting. But let's go ahead and run our prompt to see, well, why should we believe that growth rate is achievable? What are the sources that are going to be delivering that growth to Meta's business over time?
I would say one other thing to consider is with AI, and I'm not sure that our prompt hits on this because our prompt is more focused on the top line, right?
Yes.
AI could make Meta just more efficient such that it will be able to cut a lot of employees. I mean, we just heard, I think this morning, that Amazon's cutting tens of thousands of employees.
30,000.
Yeah. So,
By
I'm
the
not
way,
sure. Oh.
oops, wrong tool. We just got to try. Let's try that again. So I saw somebody post on Twitter about that, and they were worried about what that meant for Amazon's business heading into the holidays.
Mhm.
And I read it closely, and it said it's white collar jobs. It's not delivery
Right.
warehouse jobs. It's white collar jobs. And they said they overhired during COVID. So personally, I don't think that that's this. Okay, this is new.
Yeah.
Okay, it's asking us follow-up questions. What geographic lens should I use for market expansion? Global, North America, or a hybrid? Hybrid. Well, I'll go with C. Hybrid. Go with the hybrid analysis. All right, this is new. This is
Yeah.
why.
Well, this is great. I mean, it changes every day, right? I mean, that's
Yeah.
how AI has been. That was quick
Uh,
too.
for sure. Okay, so the growth analysis. Balanced growth drivers, balance new customers and existing customers. So new customer acquisitions are geographic and market expansion and new distribution. Existing customers are pricing power and new products. Okay, customer acquisition channels. Sales and marketing investment. This is moderate. Advertising revenue grew 22%. Confidence is medium. New distribution channels are strong. Meta's Reality Lab hardware plus Meta AI and generative AI investments broaden channels beyond core apps. So
I
it's,
will say I've heard good things about the glasses, but I'm not crossing my fingers or holding my breath yet.
in addition, it's such a small percentage
Yeah.
right now. It's not really needle moving revenue as of yet, but maybe that could change in the future. Geographic market expansion. So I would say this would be definite one. So they have lots of users in international markets, but whether or not they have a lot of advertisers in international markets is something that they could do. They could catch up on. Acquisitions, not so much. I don't think the government's going to let Meta acquire anything
Yeah.
moving forward. Pricing power. Can the company continue to increase prices? ChatGPT says yes. New product services, yes, with the Meta AI coming out and new AI tools. I believe that.
And WhatsApp ads. That's not a small thing if they can make that work.
Right. They've never gotten to monetize WhatsApp thus far. Customer retention is moderate. So can we keep the customers' retention going up? Okay. So what are the strongest drivers? Pricing power and geographic market expansion. All of these are secondary, and then untapped opportunities are marketing and sales and retention metrics. So yellow and green, mostly yellows and green. So, all right, let's poll. What do you guys think? Does Meta have attractive growth potential built into it?
And I am just here we go. Launching right. Why will this not launch? Growth potential. For some reason. Oh, you know what? Hold on one second.
Got to stop sharing. Now try it.
There we go.
There
Thank
we
you.
go. Yep. So, does this stock have growth potential?
I know what I think. Hey, Brian, while people are answering that, we got a couple questions.
Sure.
Richard's just asking, have you tried your prompts in Perplexity? As many think that's good for financial queries.
I have. We initially started the prompt in Perplexity on these webinars. We use ChatGPT because it's the most popular one. Each of them has their own quirks, and I've heard reports from people that you run these prompts and the financial data in particular isn't always 100% accurate. One thing I like about ChatGPT is it puts the link right next to the thing itself and you can click over and see the link right there. With Perplexity, it puts the links at the bottom, so it's a little less convenient to use those. But we have tested these in each of the major AI tools and it should work properly in each of them. But like anything, when it's giving you a number in particular, double check that in Fiscal.
Yep. And I'll just follow up with one more question from Brian. He says, has Meta completely given up on the metaverse? My understanding is no, but they're not pouring into it the way that they did before ChatGPT was launched.
Yeah, a lot of the emphasis has gone into AI from what I understand, but I still think they're definitely pouring billions into it. And what happened was 2 years ago, the market was not giving them any credit for that at all. Now the market is saying, do your thing, everything's working. So what do people say?
Yep. 2/3 basically say, yes, it's green. It has growth potential. 1/3 say kind of yellow. I'm a little surprised because for me, it's more kind of, just because they've got 3.5 billion monthly active users. There's, they can't double. If they double, then everyone is on it at least once a month. And that's the most that they could pretty much do.
I'm going to give it a great rating, considering that it's in the capital return phase. To me,
Sure.
double-digit growth in the capital return phase. If this was a phase 1, 2, 3 company, I would probably say no, it's good. But given their stage analysis, I would say that it's great. That would be my assessment there. A quick reminder to everybody: if you want everything that we're using, Stock Simplifier is all the tools that we're using, all the prompts. It's $99 if you use the link that Stoffel will put in the chat and on YouTube.
Hey,
Next,
real quick question about Stock Simplifier. Chase asks, do we need to have Fiscal AI tool to use Stock Simplifier?
the whole course is taught using fiscal.ai, and you do not have to pay for the premium version of fiscal.ai. You can just use the free version of fiscal.ai to get all the data that's in there. If you do choose to pay for the premium versions like we do, you get some more advanced features. You get a longer data set. You don't have to use fiscal.ai, but given how useful it is and that it's free, I don't see why you wouldn't use it.
There you go.
All right, next, key metrics. So there are different key metrics that we need to look and analyze depending on which phase the company is in. This is a phase 5 company. So here are the key metrics that we have identified as being the most important ones to look at. And then we have a simple red, yellow, green to measure how well the company is doing. Now, we teach you how to look up every single one of these in Fiscal, in the Stock Simplifier, but let's have ChatGPT do this analysis for us and see if ChatGPT can get it close. I will say this is the prompt that we have the most problems with because ChatGPT simply can't do the math often. Sometimes the easiest.
It has trouble knowing where exactly to look too. So like, again,
Yep.
look,
Right,
22% revenue growth and it gave it a red.
Yep. Yeah. Explain that one to me.
Yeah.
So yeah, it says revenue growth. We want this figure over 10%. It says the current value is 22%. Let's check if that is accurate. Over the last 3 years, the actual revenue growth has been 14%. So that's not even accurate there. And then it's giving it a red. It should give it a green. That's how we've programmed it to do it. So maybe I'll rerun that after we check it out and just see what it says. Okay, so this to me is a green. Revenue growth has been over 10%. Next, free cash flow conversion rate. So it's saying 84% of revenue is converted into free cash flow, and we want this to be over 90. So this should not be green.
Or not revenue, free cash flow to net income.
Thank you. How much net income gets converted into free cash flow? Excuse me. So this should be a yellow, I believe.
Well, and over the last 12 months, what's showing for me, I just pulled it up, is that the company has 50 billion in free cash flow on 72 billion in net income, which would be 69%.
Yeah, so these numbers here are not looking perfect, even though it came from it. All right, I'm gonna just rerun this and see if we get anything different because both of those were kind of incorrect. Exact same prompt. We'll see what happens here. So we should get green and then yellow. We know. All right, so now we got yellow. So now it's saying 18% Yeah, this is definitely the one that we have the most problems with, even though we've done our darndest to kind of program it correctly. So anyway, we know that this is a green. We know that this is a yellow. It's
Yep.
not converting everything properly. EBIT to interest expense,
That's
long-term debt
definitely, yeah.
is 28 billion.
Well, yeah, it's a green. We know
That's a
that.
green.
Yeah.
Return on invested capital data is not clearly available. Au contraire, return on invested capital is 30% over the last 5 years. And capital returns, yes, the company is buying back stock and it's been done so for 5+ years. So, yep, ChatGPT did not do a good job on these calculations here, but it got, and this is, so the actual calculations are green, yellow, green, green, green is what
There you
it should
go.
have what it should have been. Strengths are capital returns, definitely, and the EBIT to interest expense ratio is healthy, definitely. Concerns, revenue growth of 3 years is solid, but in the yellow zone, not green here. That is incorrect. That should be a strength for the company. Free cash flow conversion is more of a key concern area. And overall ROIC should be here. So let me just run this one more time, see if that helps at all with the analysis. Otherwise, we'll call this one as a Chat GPT failure to
Yep.
run this prompt properly. But if we go to Stock Simplifier while that's happening, I'm going to say green, yellow,
Yep.
green, green, green.
Yep.
That's the correct answer there. Let's see what it comes up with.
Oh,
Now
look at
it's
this.
saying green, 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 green. All right, so the third time would be the closest.
Yeah.
The third time was the
What's
closest,
funny
but it's not perfect.
is that it knows that that coding should be yellow for the second one.
Oh, geez. Yep. So this is the one that we have the most problems with the numbers. But this is why the numbers are so easy to look up
They really are.
in fiscal. In fiscal. Okay. Well, at least we got that one. Do we have any general questions? While we
Let's
here?
see. Someone was asking, are all the prompts that we use accessible if people buy Stock Simplifier?
Yes. Yep.
And
All of the prompts, and as we update the prompts or make them more robust or come up with new systems, you will get any future updates we do included. It's a one-time purchase of $99.
and someone, Tony and Janice, are saying, what version of the AI prompts are we using today? I think what the idea is, if you pull that page up, yeah. So I think the real idea here is that this, you will, if you get Stock Simplifier, you will have access to this page, and any and all improvements that we make to the prompts will automatically be put into here. So when you go back, you can get it again.
Yep. So this is the business analysis is 18.7. The business analysis is 2.1. We will update them kind of as we go. Okay. Next, risk section. We believe that all business risk boils down to one key risk, and that key risk is execution risk. What are the chances that this company can't execute on the promises that have been made to investors implicitly by buying the stock at the valuation? Now, there are a multitude of sub risks that boil up to execution risk. And the four we want to check are concentration risk, disruption risk, outside forces risk, and competition risk. So those are and then we have our simple red, yellow, green system for that. So let's do that risk analysis and let's run that and see if ChatGPT can get this one to be more accurate.
I'm curious to see what ChatGPT has to say about this one.
Okay, let's do meta. And we will go from there.
While it pulls that up, Brian, just real quick, we just when we have time, we got two more questions have come in, but we can hold them to the end.
Sure. Okay. So it says execution risk analysis of Meta. Overall risk level is medium. The primary risks are outside forces, regulation, and data privacy. I'd say that that's accurate. Yep. And disruption, ad tech/mobile. Key mitigations are the scale and diversified revenue base across geographics. So concentration risk, none. No customer is more than 20% of revenue. Ads are spread across many advertisers globally. I would agree. Disruption, yellow. Risk factors mentioned reduced availability of data signals, Meta warning about changes in mobile operating systems and relationships with Google, Apple. So it didn't actually say TikTok here, or it didn't say how AI could change anything there. Maybe that's in the competition as
Mm-hmm.
opposed to the disruption. Okay. Outside forces, red. This is the risk to watch. Our business is subject to complex and evolving U.S. and foreign laws and regulations regarding data, privacy use, and data storage. Foreign exchange, data localization, and regulatory investigations are key material risks. Outside forces pose a high risk due to heavy regulatory
Makes
exposure
sense.
globally. And then finally, competition. It operates in a very competitive and globally challenging environment. Competition risk is moderate and scales as meaningful. So green, yellow, red, yellow. I would say that that is spot on. And
I agree.
the key defensive position are its global scale, strong cash flows, and diversified product portfolio. So what do people think here? What do you think of Meta's execution risk? Is this a
Oops. Let me end this one. I got to go back to a bet. We've got a better one about risks. Here we go. Let's launch
okay?
this one.
What do you think of this company's risk profile? Is it high risk, medium risk, or low risk?
And one thing I'll throw out there that's really interesting, Brian, is the fact that I always used to think that regulation could be really bad for the entrenched players, but sometimes when there's more regulation, there become higher barriers to entry, and that almost locks in the incumbent. So, in a way, it's possible that regulation could actually be good over the long term for Meta.
Bill Gurley had a great talk on this on the All In Summit like a year or two ago. The big takeaway was regulation benefits the incumbent.
Yeah,
Full stop, period. The more social media gets regulated, the better news that is for Facebook.
yeah.
I would, and he has lots of examples of this happening. So deregulation is a threat to Facebook. Regulation is an opportunity. So what do
We
people
got
say?
we got 75% saying yellow, the other quarter saying pretty much green. So I would say pretty solidly yellow.
Yeah, so I would say that this is probably I'm gonna go with yellowish green. If I had to choose, I'll go yellow. Sure, yeah, yellow for the regulatory aspects here. Okay, next valuation. So the primary tools that we're going to use to evaluate Meta are the PE ratio and the price to free cash flow ratio on a trailing basis. So to look this up, we go to fiscal. AI can't help us with this as of yet. We're going to close out of that, and we're going to go to ratios. And then we're going to go to trailing valuation, and I'm going to look at trailing price to earnings ratio. And what do we got here? All right, so the number was kind of crazy back here, 100 times earnings. It looks like it settles out about 2017. So
Yeah,
I'm just
I
going to
agree.
pull this forward to about 2017 to give us a trading
That seems like a
ratio.
pretty reliable range you've
It
got right
does
there.
to me too. We'll add a low, high, and medium. So on a median basis, this company trades at 27 times trailing earnings. Wow, it got down to
Hey, isn't that crazy?
8 times trailing earnings in November of 2022.
But look at how quickly. So we're talking in a matter of like 6 months, it went from 8 to what is that at the top?
40, 39, 38.
So it 5x'd without it would have 5x'd even if earnings didn't increase.
Yep. But the market is perfectly rational, right? So you're telling me that one of those biggest, most well-known, most widely covered companies in the world is within a 12-month period is worth 8 times earnings and 40 times earnings? Yeah, that makes the market is perfectly rational. If anyone ever says to you, show them this chart, and says, okay, so that's price to free cash flow. That's price to earnings. Now let's take a look at price to free cash flow, which should be a bit higher since we know that the company is not converting as much cash flow into this. So high, medium, and low. So all-time high or 10-year high, about 44 times. It got as low as 10 times free cash flow. Currently 37 times free cash flow. The long-term average is
And
about 28, 29 times free
and I would
cash flow.
say the big reason for that is how much they're spending on on AI.
Yep, sure is. So with that in mind, would love to get people's opinions about this. What do you think of the valuation today? Is this a attractive, undervalued business? Is this a fairly valued business, or is this an overvalued business? And we'll use the stock simplifier main ones, but if we want to, we can also take a look at some of the phase 4 metrics as well.
Yep.
And that might give us a different view. So while that poll is coming in, I'm going to do the exact same analysis, but instead of using the trailing numbers, let's assume that we're going to be using the forward numbers, which is what we would do for a company that was in phase 4. So here are the forward numbers. That looks just about the same.
Yep.
Pretty honestly, that's price to earnings. And if we use price to free cash flow, do that exact same analysis.
Woo!
Oh, 60 times next year's free cash flow because of that AI spending. I have a feeling that the results of the poll would be the same. But what do people think?
So we've got 2/3 saying fairly valued, a quarter saying it's overvalued, and there's actually 10% that say it's undervalued.
Okay. All right. So we will go to stock simplifier and we will say, we'll go with fairly valued since that was the most popular one. Final poll question. What do you think of Meta stock? Are you interested in owning this business? Red, not at all. Yellow, maybe, perhaps, yes, at the right price. Or green, I want to buy this stock today. It's a great business and a great compounder.
Yep.
And as people come in with that, would love it if you could offer your opinion too.
I will say for me, it's a yellow. It's so big. I will say it's so big that it needs to be an attractive valuation. And it's not a bad valuation by any stretch, but I'd like it to be attractive. Maybe I got spoiled because I bought when it was, not quite at 8 times trailing earnings, but around there. So here I can share our results. We've got 57% said yellow, somewhat interested. 32% said yes, and 11% said no, not interested at all.
All
So
right,
I would say that it was pretty solid yellow for our viewing audience. Mr. Feroldi, what about you?
Yeah, so the consensus here from talking with people is this is an excellent business that's executing very well. It's got good growth prospects, it's moderately risky, and its valuation today would be fair-ish. I'm going to go with the wisdom of the crowds here and also say this is a business that I own personally for years, have owned personally for years. I would not be interested in adding at these levels. And if it continued to go up, perhaps this could be a candidate to even trim a little bit. But I think the valuation today is on the fair / overvalued side. So I would not be a buyer today, but this to me is a great watch list stock. You?
Same.
Same.
I always I review my portfolio and my watch list stocks every 6 weeks, and this is on that list.
There you go. Okay. Do we have any general questions about Meta, about the research process, about Stock Simplifier, anything like that?
Yeah. So Brian asks, is Meta available in Russia and China?
I know for a fact it's not available in China.
Yeah.
I don't know about Russia.
Okay. Richard says, is there a chance that Meta might be forced to unbundle its different products? And I'll just throw in there my own. Would that be a bad thing for investors?
Yeah. So I'll say, is there the possibility? Yes, there's definitely that possibility. And I am in the camp that says that would be good for investors.
And let's explain why.
Yeah. So if a company gets broken up into its different components, each of those components would be valued on their own by the market. I have a feeling that Instagram would get a very high valuation. Traditional Facebook would get a lower valuation. WhatsApp might get a mixed valuation. So if this company was forced to spin things off, that could actually unlock shareholder value. Think about when eBay owned PayPal, right? PayPal was trapped in eBay's valuation. When it got spun off, PayPal today, even with the decline we've seen, I believe is more valuable than eBay alone was before the spinoff. So sometimes spinoff and forced splitting of the business can actually unlock value for shareholders as opposed to the opposite.
Tony and Janice asked, we got a couple different questions. Is there anything we can do to improve the ChatGPT performance for that key metrics section?
Yeah, we'll keep banging away at it. I mean, the prompt is pretty robust. The prompt is pretty do this in this order. Only use SEC filings. From what I understand about AI for whatever reason has a problem with numbers, which you think would be the easiest thing for them to do. That's why the AI that we build in there is a companion. It's an accelerant of the process of researching a stock, but you still need to know what the terms mean. You still need to know how to look them up in fiscal.ii. That's why Stock Simplifier has the whole course that teaches you how to look them up, and importantly, why they're important. So
Yeah.
we'll continue to work on them, but as you've seen with AI, it's not perfect.
And I'll put out there what Cass said, which is go to Fiscal AI and just check. Because the thing is once you learn how to use Fiscal AI, which shouldn't take too long, it takes minutes or a minute to check some of those things, which is great.
One other thing that we're kicking around that may help to solve that problem is, what if you download the most recent annual report as a PDF and you upload it to ChatGPT and tell ChatGPT you're only allowed to use this source that I've uploaded. Like, forget looking up the data yourself manually. You must use the source. We don't know if that will help to increase the accuracy. That's an extra step and an extra thing that you have to do to research the company. So we're weighing that in our mind, but that might help.
Yeah. And I will say these things all change day to day too. I mean, we got asked a couple of extra questions today that we've never seen before.
I've never seen ChatGPT ask for further clarification after putting those notes in. So lots of moving parts with AI.
Jason was wondering if we would consider adding a reverse DCF when we do these to our process when we do the valuation.
As part of the live streams?
Yeah.
Potentially, yes. So keep in mind, stock simplifier.
Yeah.
The second word is simplifier. When we were building it, we asked, what is the simplest form of valuation? The answer there is obviously multiple analysis. It's the one that's the most common. It's the easiest to look up, and the tools are already created for it. Both Stoffel and I are big fans of reverse DCF calculators, but it is more complex. So for that reason, because of that additional complexity, we left it out of Stock Simplifier. We do have a whole course, a mini course that we built on reverse DCF calculators, and we do provide the tool. If you do want to add that on, we do have that as an option. So that can be something that we consider in future sessions if that's something that people want to do.
So got a question here for you. First, a couple people were asking what was going on with Facebook when it was so low. It was a combination of two main things. Thing number one was that we were entering 2022, and I forget, predictions were like 80% chance of a recession. If there's a recession, ad budgets come down, and so that was part of it. The other thing that was happening at Meta in 2022 was the fact that for, I think, the first time ever, it was either monthly or daily active users declined. So think about those two forces. Everybody got worried about ad budgets, and the number of people using it declined for the first time in a really long time. That made people really, really nervous. That was the big thing.
Let's ask AI. Let's see if it can find that information out. I think what you just said is spot on, but I'm curious what AI would say to that.
While this is answering it, Brian, Jason said he's getting a little nervous about the AI bubble. He doesn't think it'll pop for a year or two. He was wondering, like, how do you, someone who's heavy in AI stocks, how should they be planning to approach this? Any thoughts on that?
It depends on how heavy you are into AI stocks. So a key question to ask before you make any investment: when do I need this investment to pay off? It's a very important question to ask. Is the answer to that 30 years from now? If that's the case, you might be able to overlook short-term valuations and volatility and that kind of thing. If you're investing with the hopes that your money grows in the next 12 months or 6 months to 18 months, you might have to be more defensive in what you do. Personally, I am in the camp that says there is a bubble in AI, and I am currently at a 30% cash position myself. Personally, I've been trimming some of my stocks to build up my cash position. I have no idea when this party is going to end. And the interesting thing about the quote unquote AI bubble, there's two forms of bubbles, two types of bubbles. Bubble A is prices go bananas. So the companies that have no revenue at all, and you see their valuations just creeping up, that is a price bubble. Another type of bubble is way harder to look for, and that is a earnings bubble. When there's when companies are over earning, well, that did not work. Where companies are over earning because they're taking advantage of some temporary trend. So, for example, is Nvidia's earnings power durable in nature, or is it temporarily in a bubble? I don't know. But but if you look at the price to earnings ratio of Nvidia, it doesn't look insane. It doesn't look crazy. But if that's only the case because the earnings right now, the earning power of the business is way over what it should be, then the valuation, even though it looks good, might actually be very high because the company is over earning. That's a much harder bubble to spot.
I totally agree with that. I think that's spot on.
Wow. Okay. Well, ChatGPT is
This was
not
too hard of a question, apparently.
apparently. Let's try Grok. Grok seems to be better at those kind of things, or at
I
least
agree, and I'm
fat.
actually very curious what Grok has to say.
Yeah.
Uh, while it does that, another one. Andre's asking, what do you think of Peter Lynch's PEG ratio? Is it? Yeah. What do you think?
It used to be great. It used to be more meaningful, but it no longer is. Using the PEG ratio was a fantastic tool in the 80s and into the 90s when he was picking stocks. It has lost its usefulness due to, for one reason, because of accounting changes. Another reason is the nature
Yeah.
of companies today is they don't necessarily show their true earnings power early in the cycle like they used to. So I think it's something to put in your tool belt. But to me, there's more limitations to the tool than there is positives. You?
I agree completely. And I would also underline what you said that with the accounting changes that happened, a company's investments count as part of their earnings, and that doesn't make any sense. So that I would say that was a big part of it.
All right, so here's Grok. Meta stock was 88 per share, 75%. Metaverse bet backfired. Apple iOS privacy changes. Yep. Ad market collapsed.
That's the one I said.
TikTok's eating its Reels launch. Overhiring and bloat. And market sent that all led to market sentiment and multiple compression. I would say, wow, Grok, you nailed it.
Well, they still didn't catch that their daily active users went down. Like that to me was a big one that I think was a big thing that happened.
And Meta called 2023 the year of efficiency, and then the stock quadrupled since then. But this is a darn good explanation, and it actually gave us a result versus ChatGPT.
I don't want to throw too much shade on it. That is a very good explanation. Madhu asked, someone said the way the earnings are calculated now has changed over the last 10 years. Yeah, I mean, Madhu, here's the great way to think about it. Today, Amazon's earnings are more driven by what Rivian stock has done than anything else. Does that really tell you how Amazon's business is doing? No, it doesn't tell you anything about it. And unfortunately, because of that change, it renders the PEG ratio useless in certain cases.
Yeah, that change was what, 2018?
I can't remember. It was within the last 10 years.
Yeah, definitely. So for those that didn't catch what Stoffel just said, if one company owns stock in another publicly traded company, that company has to report an increase in the stock price gain as earnings and a decrease in the stock price gain as a loss. So Shopify owns stock in Affirm, publicly traded company. So Shopify's earnings are going to increase or decrease based on, did Affirm's stock price go up or down? Or think about Berkshire Hathaway, which owns hundreds of billions of dollars in other public equities. So that is a legitimate accounting change that makes the earnings of many companies that own stock in others irrelevant. It's no longer a useful figure at all for Berkshire Hathaway, for Shopify, Does Microsoft have that problem? Anyway, there's a couple of companies. And then stock-based compensation prior to 2003 was not treated as an accounting expense. It was not an
Yeah.
expense on the
Yep.
income statement. Now it is recorded as an expense. This is one reason why I've heard the cyclically adjusted PE ratio, the CAPE ratio, is no longer an accurate way to measure the market's valuation, because that one factor is causing earnings to be depressed today. So this is why knowing the nuance of accounting is important when making decisions.
Yeah. And Brian, so I went back and I found it. So it was the Christmas quarter, the holiday quarter in 2021, which was reported in like February, March 2022. For the first and only time ever, the daily active users at Meta fell by 1 million people, which isn't much because they were at about 2 billion.
0.001%.
But it was the first and only time that it had fallen. I think that played a role as well.
I remember when Netflix had their Quickster moment.
Yeah.
Right? People were freaking out there, and people were like, "I'm gonna cancel." They're raising prices like crazy. That quarter, their membership fell like by like 100,000 or something like that on a base of like 40 million or something, and people flicked out. So if you follow companies like that, narrative follows price. What just happened to the price of the thing? That's where the narrative is going. What's the narrative of gold right now? Must have asset in your portfolio. That's because the price has gone up. Narrative follows price. that's just how human nature works.
Yep. I think that's pretty much it. We've got, again, the link for Stock Simplifier is in there. One last thing, because Brian, I know you have experience with this. Fiscal AI versus Koifin. Your experience with those two.
I personally prefer Fiscal.ai. They are a sponsor of ours, and it's the platform I know best. So we before we kind of chose a platform to partner with, we looked at lots of them, and to us, Fiscal.ai was the most intuitively laid out, had the best information, had the most accurate information, and then their custom KPIs section that we used in this
That's a big deal.
Is a really standout feature. They now have instant updates, so when Stoffel does earnings reports, it's like in the system within a matter of minutes. So we like Fiscal.ai best.
Yep. All right. I think, oh, there's one more. One last question from Cass. I'm wondering if bouncing back from a recession is indicative of strength. My understanding is that many companies will suffer in a recession, but some crash and burn while others bounce back with fewer competitors. I think that's a perfect explanation of what happens.
Yep. Makes sense to me.
Yep.
Cool. All right. Well, thank you guys so much for joining us today. As a reminder, with Stock Simplifier, you get a course that explains everything. You get the tool, and you get all those AI prompts. We also have a 30-day money-back guarantee. It is going to be $99 if you use the link below that's in the chat. That brings us to the end of Meta for today. Join us tomorrow, Wednesday, October 29th at noon, same time. We're going to do this exact same analysis on Microsoft. And then next week, we're going to complete it out with NVIDIA on Tuesday and Tesla on Wednesday. So those should be very, very fun. So thank you guys so much for spending the hour with us. We really appreciate your time and hope this was useful. See you tomorrow. Brian's out.